Good morning, everybody. Happy Thursday. It's September 21st, as Earth, Wind, and Fire just told us. September 21st, 2023. Great to be with all of you today. My name is Bob Lang. It's time for our daily bites. Lots and lots to cover today after the Fed meeting yesterday, the statement, the press conference. The markets sold off pretty sharply, more than 1%, and we're even down another 1% or so this morning. In fact, the Nasdaq's down a little bit more than 1%. The Dow Industrial is not quite 1%, but and the S&P 500 really close to that. So volatility is up. You can see the VIX is up over 16% today. And we've been talking about this. We've been talking about how the market has been extremely complacent. The expectations that the Fed was going to be a lot less aggressive. At least the assumption was that the Fed was going to be a lot less aggressive. They're going to start talking about rate cuts, no more rate hikes, but we got the opposite, right? And this is something that you have to be aware of. Pay attention to what the Fed is saying and what they're doing, and not try and listen to anybody else's opinions to create your own narrative about what they should be doing. We only have one Federal Reserve and one body of a committee, and they do certain things, and that's what they set policy, and that's what we have to live by. So they set policy yesterday. They didn't raise interest rates. They didn't cut. They kept the funds rate at 5.25% to 5.5%, but they did indicate through their statement and through the press conference by Chair Powell that they were going to be raising rates one more time before the end of the year. Now we only have 2 meetings left in 2023, one in November, one in December, and we could see another rate hike coming in one of those 2 meetings. I suspect, my guess is that the next rate hike will be coming in November. They're going to pass on December, and then we have a whole new group of voting members coming in at the first meeting at the end of January. And I think the Fed funds futures right now are only projecting perhaps a 30% chance of a rate hike in November. 40%, 43% chance actually in December. I think that rate hike is going to come earlier. I don't think they're going to mess around and raise interest rates right before Santa Claus makes his run at the end of December. So that's just my guess. But let's talk about the rate cuts for a second. Rate cuts, are they going to be coming in 2024? What the Fed projections looked like yesterday was that they're going to raise rates one more time and then maybe take back that rate hike and maybe one more in 2024. That's it. Maybe 1 hike and 2 cuts, or maybe 1 hike and 1 cut in 2024. It's really not making much of a difference at all. Okay, so that's what we're having to play with, and that is what the market is trying to struggle with. I think overall we're sitting in a correction right now. In fact, if you take a look over here, my good friends over at the Investors Business Daily yesterday say market in correction. And of course, a lot of people follow what the IBD does, and they're very, very smart people over there. They were in market uptrend under pressure for about 2 weeks or so, and now they're in market in correction. So a lot of people follow this, and it becomes a self-fulfilling prophecy when you see these sort of things. People see this and they start selling as well too. That's not necessarily the reason for the markets to go down, but it could certainly exasperate things and push the markets down even further. Let's take a look at the charts here for a little bit. So I want to take a look at a few. S&P 500, look at that thing. That just fell right out of bed yesterday. Was challenging that 20-day moving average for about 2 or 3 days, and couldn't break through it, and tagged the 50-day moving average at the open yesterday, and actually went up right after the Fed statement came out, because there were some buyers that stepped in there. The algos really went crazy right after the Fed statement was released, and we pushed lower after that. So where could we land? Obviously, the first logical spot would be this 100-day moving average on the S&P 500, which comes in at about 40. Looks like 4374, which is about 30 handles lower than where we're at, and looks like we may bust right through that this morning. We did have a nice reversal candle when we made our way down there towards the end of August last month, but so we'll see if that holds here. And that was that low comes in at around 43.56. The ultimate low that we had in August, of course, was 43.35, just above the gap that needs to get filled at 43.30 or 43.29. So we didn't quite get that filled in August, and we could make a move down there. Look at the cloud. The cloud is red, so it's technically, we're technically in a correction right here, and IBD is right about that. MACD is rolled over, and look at the concentration of heavy volume in September. We've had mostly down days in September. We've had only 3 up days, I believe, in September, 3 or 4 up days all month long, and that's 5, 10, 15, 14 sessions already in September, and only 3 or 4 up days. Very similar situation that we had in August, until that last week in August when the buyers stepped in. So that situation is very similar. And if we do rally at the end of the month in September, which starts the last week in September, starts on Monday. If we do rally like that, and it's a carbon copy of that, it'll be interesting to see where things land. As it is right now, though, we're in correction territory right now. You don't want to be long stocks, and if you are long stocks, you should have some protection on it. We've been talking about protection for weeks and weeks and weeks. You got to have some puts on, even on days when the markets are up. You can also make some money on these puts, especially when there's some volatility in the markets. When there's no volatility in the markets, where you're going to be having a sharp move up or a sharp move down, you're not having any big movement. Now, remember something: when the VIX is high, it's starting to move up. That means you're going to have some big swings, right? When the VIX is low, as it was, say, yesterday, 13%, we didn't have any huge swings in the markets yesterday. We did have swings, but they weren't huge swings, right? The big movement in the markets came to the downside, and either moves to the downside or the upside. Those big moves happen when the VIX is low. So if we get the VIX, may say, up to 20% now. We're up to 16. If we get a move up towards 20, maybe 22%, we're going to start having some big movements intraday in the markets, maybe 1 to 2%, perhaps intraday. But one thing that we've been talking about endlessly for about 2 months now has been the breadth. And the breadth, or the new highs, new lows, are what I'm talking about here. And look at the August and September. It's just absolutely atrocious here, right? And I've been telling you this. This is going to signal weakness in the market in the future. It is a great predictor of where markets are going to be going, right? New highs, new lows. So we've been seeing huge prints in the Nasdaq, new lows versus new highs. This is the NAHL. Big prints since the beginning of October. Only a couple of prints in the positive that were at the end of August, right? But mostly concentrated on new lows being created. Look, if the markets are not making new highs, new price highs, if stocks are not going up and making new highs, they're not going up, they're going down. It's that simple, folks. So if the market's not going up, it's going down. And frankly, the pressure of the markets, this is like trying to push a ball down in the water, right? Just keep pushing it down, keep pushing it down. All of a sudden, it's going to burst, and you're going to see a big flow of money out of the markets, and you're going to see the markets starting to decline. Am I bearish? No, I'm just telling you what the conditions are like right now. If this was flipped around and we were bullish like we were back in June and July, with high prints in the positive, with new highs versus new lows, hey, listen, I'm thinking the markets are going to go higher. But I have to look at the evidence here, the technicals, and they're telling me that this is a bad condition to be in. And you want to see a history on this one? Let's go back to 2018 and 19, right? Let's take a look at that for a moment here, and you can see what I'm talking about. Let's look at the weekly chart here. Let me expand that out a bit here. So that goes a little bit too far. Let's take it down. So back in 2018, you can see towards the left side over here, we had some big, huge prints in September and October, right? Big, huge prints down on the Nasdaq in September and October, even though the markets were making new highs. S&P 500 beginning October 4th made a new all-time high. And just after that, we saw some heavy selling occur, and then you saw the markets just fall apart in December. We were down almost 10% in the month of December, right? And that simply is following through from the new highs, new lows list, because we're making far more new lows than new highs. So that's a good lesson to learn here. This is a great indicator that tells you where the markets are going to go. It's a great predictor. There aren't very many good predictors out there of what the markets are going to do. You get some good ideas of what they're going to do, but this is a really solid one. So higher new lows than new highs is a troublesome situation if you're bullish. All right, next chart I want to show you here is the TLT, which is the ETF Treasury Bond Fund for the 20-year Treasuries. This thing has been in a huge downtrend since June. It's fallen more than 10% since the middle of June. It's going to open up near 92 today, which is the low back in August. And if it fails down over here, we're going to continue to see bond sellers push this ETF even lower. Now, why are bond prices going down? Look at the yield. This is the 10-year yield. We closed at 4.35 yesterday. Look over to the right-hand side. We're almost to 4.5 on the 10-year. 4.5 on the 10-year, and that is a new relative high here. We saw the TYX, the 30-year, closed at 4.4. We're at 4.528. It's a huge move in yield to the upside over here. And why is that? It's because people aren't wanting to hold bonds when inflation is so strong. Well, some of you may have heard Chair Powell yesterday saying, well, we had a good improvement in the core inflation. And he even said top line inflation is improving. I got to tell you, with oil prices at $90 a barrel right now, and we had a huge print in CPI last week with the about 7.4% on an annualized basis. And unless oil prices start coming down, which I don't see any evidence of that happening, we're going to continue to have high prints in inflation, and that comes back into the economy as well too, and it just makes things a lot worse. When you also add into the fact that wages are starting to increase. All right, we're seeing a bill that's going through in California. It's going to make a minimum wage of $20 an hour for fast food workers. We're seeing a lot of these unions starting to flex their muscle. I wrote an article in Action Alerts Plus and in actually Real Money Pro. Take a look at it when you get a chance, about talking about unions and the power they've suddenly achieved, and at the negotiating table at the collective bargaining. So this is an important factor because higher wages eat into the profits of companies. If they don't have any control over those profits, they're going to end up doing what? They're either going to lose business or they're going to raise prices for us, the consumer. And that's already been happening. If they raise prices for consumers, this is the sort of inflation that the Fed has been trying to fight. Okay, so we have that. We have the table set over here. The markets are going to be down a little bit. We have some puts. We've been preaching to you for weeks and weeks and weeks to have some protection on, have some puts on. It's not a drill. Okay, this is not a fire drill here. This is real life going on right now. And if you're not protecting yourself, you're taking some risk that you don't need to be taking, right? I get it that a lot of people don't like to lose money putting money in puts. I get it that people don't understand how to use puts, and I also get it that people don't know how long they should be holding their puts. All right, so if that's the case, go to the sidelines, have some cash. I have a lot of cash on the sidelines right now. I'm going on a trip. I won't be here next week, but having a lot of cash on the sideline is also a position. It's also defensive, and it's also protective, right? So if you're not comfortable holding puts, fine. Just have a lot of cash on the sidelines and wait things out. I'm going to repeat myself here. This is not a dip to buy. I'll say it again. This is not a dip to buy right now. When the markets are in correction, this is not a dip to buy. There's going to be an opportunity and time and a chance to go ahead and buy stocks again. It's not right now. We're in a seasonally weak period. End of September is usually the worst part of the month and also probably two of the worst weeks of the whole entire calendar year. So why would you get involved here? Why would you do anything? Why not just wait until the markets stop falling? right? How do we know that the markets can't drop below that 43.40 level that we saw in August and keep going? There's some support down all the way down to where? 4,200, maybe even 4,100, even further down. So anyway, that's going to be it. That's my warning for all of you. I hope all of you are safe here. I will be out all next week. I won't be back until October 2nd. My wife, my family, and I are going on a trip to Italy. We'll be back October 1st. So you won't see me all next week, but I wish everybody a great weekend, a great week of trading next week. Protect yourself. Again, it's the last week of trading in September next week. Friday is the last day of the month. I know a lot of people are going to be talking about the new JP Morgan collar, which is coming out. I don't know when that's going to be out there. Probably going to be out there on Friday the 29th. But, frankly, everybody gets all excited about that. It's really just a neutral position anyway. It doesn't mean anything. All they're doing is protecting a long position. We can go into that another day. I'm probably going to write an article about that. So anyway, we're going to break it off here. Have a great day, everyone. Have a great weekend. Good day of trading, and I'll see you guys all on the other side of October when I get back. Take care. Bye.